Hello, everyone. Welcome back to another live trading session. It's not so much live trading session as it is reveal, if you will, of the updated UOTS strategy. I just came back a couple of days ago from my 2 weeks holidays. I was away from the markets and mostly away from the internet, basically. So I had plenty of time to think about the markets without really going deep into it. So thinking about concepts and things of that nature. And I came to some interesting, well, to me, interesting conclusions. We'll see how you like it, but stick around. I think you'll like it. We have a little bit different, unique approach. It's not something most people do, so it is pretty interesting. But it's gonna require me to go a little bit over the concept before we dive deep into the actual strategy and the mechanics. I want to go a little bit broader, so we'll do that. And at any point, you can feel free to unmute yourself and jump in, ask any questions. Because if you have any questions, I'm sure somebody else will have, and that will help the session be more productive. But to start off, let's just quickly recap. I know nobody really wants to go over the Volmageddon, but we do need to just take a look and remind ourselves that we fallen off the let me just put this yellow thing, that we've fallen off the cliff here. What was it, Friday, early Friday, and then Monday again, and we got hurt pretty badly. We already know that. We went over the details of that. But that's it. It is what it is. What we need to do now is recoup, figure out how to, what to change, what approach to take, and then go back and fight for, more profits and better things. But we're gonna do it in a little bit different manner this time. And to do that, let me also go quickly over things. I know I covered some of these on the last video when we talked about, what went wrong and whatnot. And we mentioned things like over leveraged. I was over leveraged. Many option sellers were over leveraged. I would say most of it is judging by the Discord groups and YouTube videos and stuff. So that's number one. That's a problem. That's generally a problem when you're selling options that are kind of far away from the money, and the further away from the money you go, generally you will be more leveraged in order to keep up with the profits that you desire because of the smaller premiums and whatnot. But that it is what it is. And then the strategy, whatever strategy you use, it might be more inducive to get you over leveraged than my particular strategy. Even though I try to keep it under certain limits, measuring different parameters, it was still a little bit too easy, I find, to get yourself a little bit too exposed. So that's something that we're going to look into. That's partially up to the trader and partially up to the strategy itself to keep you aligned. So we'll see if we can address that as well. Gap open, can get out in time. It's perfectly fine to count on certain stop losses, certain stops. But in reality, when shit hits the fan, oftentimes that's not realistic. And I always counted on that. Like if my stop loss was 200, I'm fine with 250. I mean, I'm fine with 300. I would have probably some hedges to cover for that. But when it gets to 600 or above, then all of your models are destroyed. It doesn't really matter what you planned and what you did. If you can't get out anywhere close to what the plan is, then it's just not good enough. Then we have some slippage. Obviously, that plays into the stop loss amount, because once the VIX gets very, very high, the fear hits the market. The market makers want to make sure that they're not getting themselves in trouble. So the bid-ask spreads get wide. The slippage plays a large role. And in an event like the last one, the slippage was really high, and especially in less liquid products like MES, maybe a little bit less so in ES or SPX. But anyhow, liquidity, and then the PDSs that I had were just really not helping at all. I was hoping for just a little bit more help from them, but no, they didn't help. So what I wanted to do when I was thinking about how to approach this, I faced the choice. Do I take the existing strategy? Because regardless of the actual performance over the last couple of weeks, the strategy itself is not bad. There is nothing wrong with it. We were just over leveraged, and that's the start of everything else going wrong. So you could kind of adjust certain things. We could address the PDS, we could address the leverage, we could address some of those things, but we can't really resolve all of the issues. And the next Volmageddon will happen. It might happen in a few years, but it might happen in a few months, but it will happen. It's something that repeats itself. It's not something that's once and done. The last one was pretty dramatic, but it just gives us a taste of what can happen and how easily it can happen. So I didn't really want to just go ahead and do little tweaks, even though that's one way to do it. And there are a lot of strategies out there that are good. There is no right or good. There are many different ideas that are good. I'm going to be talking about my idea, and then we can see how you like that. Now, I do want to mention, please do not follow me, even if you like the strategy initially. Do not just follow me blindly, because it's a little bit of uncharted territory, and I'm willing to take a risk with my own account and then adjust as we go, and then maybe over time you can slowly get into it if it works. If it works the way we hope it would, and so keep that in mind. And then at the same time, just want to mention that I did the concept. I talked about most of the things, but it's very hard to predict what's going to happen when the market moves strongly. Like, you can't really fine tune everything. So we'll talk about generic parameters and some ideas and the concepts, and then as we go, as we see what market does, we'll be changing parameters to make sure that we get what we want out of it. So with that said, let's do this. Let's take a look at the. I have this little what do you call it? The pad for writing. Yeah, there you go. And hopefully this works fine. Let's see. Just a second. Okay. All right. So one of the main things I wanted to address was the leverage. How do we keep making money and not over leverage ourselves? Well, one way to do it is to sell less naked puts. Now, let me just go back a little bit before we go any further. I want to mention that this particular strategy will be divided into like two main parts, one of which is a backbone. Let's call it backbone here. And this is you can call it an always on strategy, even though it's not necessarily always on. You could take a break day or two if you feel like it. I mean, the whole UOTS 2.0, and this is just for lack of a better name, I just figured, okay, I'll just call it UOTS 2.0 for now, is that, what was I going to say? That, oh yeah, the whole strategy is a little bit more discretional. We're not going to follow mechanics 100%. We're going to just follow the mechanics to a point, but allow ourselves to do some discretionary decisions. And that's going to be particularly on this side, which is going to be more defined risk trades. Things like credit spreads, broken ring butterflies, regular butterflies, credit spread, debit spreads, things of that nature. And we can put those more opportunistic in a more opportunistic way, maybe looking at the VIX or the market movements or things like that, and the maybe delta that we need in the account. But we should be able to use the backbone strategy on its own. So the backbone strategy has to work on its own. The other part should enhance it, particularly if the market is going down, and then it would provide some relief, because the way this strategy is structured is you have to, like everything else, we have trade-offs. So there's going to be trade-offs with this one as well, and this is going to be particularly maybe during like a slower drawdowns in the market, and also more often we'll have little pullbacks. But once we get there, you'll have a better idea of that. But this is today we're going to talk about the backbone strategy. We're not even going to talk about this at all. We can deal with this as it comes later on. We don't want to be doing that right now. We want to be talking about this one right here. So let me then start with that one. So the main idea is in order to avoid slippage, to avoid passing your stop loss, what's the best or easiest way to do it? It's simply to not have any stop losses. So I'm not saying that stop losses are bad, but they're hard to implement, especially if they're kind of tight, like 200%. And then if you go more than 300%, then they're becoming questionable for different reasons. So if you can construct a strategy that works without stop losses, you're one step ahead, because you don't have to deal with slippage at the time when the slippage is the highest, or when the gaps, when you have gap opens and things of that nature. So I was thinking, can we construct the strategy not to have a stop loss? Well, as a counter to that, we also don't really have profit takes. So we're going to be a little bit more dancing with the market, taking what market gives us on any particular time, and then dancing around the top of the market as it moves around. And if you think about leverage, and if you think about VIX, and then so this is what I want to talk about a little bit before we go further. Think about VIX, and I'm going to broadly say you have low VIX, you have kind of like a mid. This is what you would consider, let's say, I don't know, let's say 16 to 19, something that generally speaking market usually wants to come back to over time. Then you would have low, let's say anything under 16, and then elevated. I don't want to say high, because high would be like 30 or something, but elevated for the most regimes would be, say, over 19, right? We will use that as a starting point, but please don't get hung up on exact numbers, because the whole idea is just moving through those numbers. We're changing certain things as we go along that scale, but we want to have these three main regimes in which we operate. And what's normally happening when the VIX is low, let's say anywhere under 16, under most circumstances, most of the time we have market going up slowly. It's basically drifting up with a small pullbacks here, there. This we can take a look at the chart later on, but you will see that that happens for prolonged period of times, and we had that up until a couple of weeks ago. We had that for a long time. So this is with a low VIX. Obviously, if we're talking about 10 VIX or 9 VIX or 11 VIX, that's even more pronounced. Market is really steadily going up. As you come closer to 15, 16, maybe there's a little bit of normal fears getting priced into the market, and maybe larger movements are expected. Then we have the general wishy-washy market, like 16 to 19 roughly. This is what's considered normal, and well, not normal, but considered generally like a midpoint. And what happens with the market? Market goes up, market goes down. We don't really know. There is a little bit more theta in the market. Premiums are a little bit higher, and then let's just remember that during the low VIX, obviously the premiums are low, but there is more drift in the market. Then there's a little bit less drift in the market, but the premiums are a little bit better here. And then once we go to elevated one, we have the market, potentially going a little bit more down. It doesn't mean that it goes down completely. It just means there's a little bit more risk price to the market. The theta is getting higher, the premiums are getting higher, but there is less natural drift to the market. So if you think about how we make money as premium sellers, well, we always like to say we rely on our theta, but that's a little bit of not exactly right. Yes, theta it is, But theta is also a function of delta to a certain degree, because the data is getting pulled out of our premium of our options as the market is moving up, as the delta. And when I say delta, I'm just talking about market movement. So in an ideal world, given these three general states of VIX and the market, what would we like to have? Well, I would argue that in a low market, I would like to have very low leverage, because when the VIX is very low, I'm not me, but the market is most likely statistically to go into an overdrive and to have your VIX triple, quadruple, maybe go five, like to go from 10 to 50. It's going 5 times higher. It could go even 6 times higher. That can happen relatively, not easy, but much easier than going from 30 to 90. That's not that likely, right? So because of that, we want to have as little exposure, leverage, and notional exposure as we can. So what we would like here is for our premium to come more from the delta and a little bit less extent from theta. And for the reasons that I said, and please stop me if I didn't explain that correctly. I can go back over that. But generally speaking, there's a little bit more delta involved, a little bit more natural drift, and we would like to capture some of that premium and rely a little bit more on that and a little bit less on theta. Now on theta, in the mid-range, we want to increase and hopefully get a little bit from both sides, from delta and from theta, but like it not particularly pronounced one way or the other. And then our leverage can go to, let's call it medium, whatever that is. I'll go over that later on. But leverage can increase a little bit because we're a little bit less susceptible to huge VIX spikes and or huge pullbacks in the market. Market pullbacks are always possible, and they're not always correlated with the VIX, 1-for-1. But generally speaking, most of the time, they are very correlated. And like in August, it wasn't that correlated. We had a huge spike, but then the market didn't go as much down. If the market continued to go down a little bit further, then it would be a lot more hurt in the accounts. But it is what it is. And then we go to elevated VIX, and with elevated VIX, we want to get majority of our premium or our profit from theta, and a little bit from delta if possible, but mostly from theta. Also, at this point, our leverage can go higher. Not necessarily high, nowhere near what we were doing before, but we can go a little bit higher. VIX is high. We can take a little bit more risk. So we are now constructing a strategy that is taking into account these parameters. And then when we're talking about leverage, just to give you an idea what I'm talking about here in this first step with the low VIX, I'm talking about, and this is roughly because it's going to depend on the instrument that you use and the size of the account, and you can't really go precisely because there are only limited amount of instruments, and then like your account can go up or down in value. It's going to change. But generally speaking, I would like a starting point for calculations to have less than a full like 1-for-1 exposure, so around a half of notional exposure with a low VIX environment. Obviously, the lower we go, the less we would prefer, but like somewhere in that neighborhood. Then maybe when we get to this level here, maybe somewhere around 1-for-1 exposure on the notional exposure or leverage. And then when we get to the elevated one, maybe somewhere in the neighborhood of 2 would be acceptable. And then keep in mind, obviously, if we are at this stage here, we might be at 2. Even if we are at 2x here, if the market continues down and or VIX continues to go up, well, our account balance will go down, and our exposure will, of course, will go higher, even though we didn't buy any additional, sell any additional premium. It'll naturally increase from this point on. But we have mechanisms that would kick in at some point. So, is there any questions up to this point? No? All right. Well, very good. So let me see if I can move this around. So I can't move this. Let me see if I go here. I can do it now. Okay. So I want to talk about one more concept before I go into the actual system and the parameters, and we jump into the platform and talk a little bit more. Or actually, we'll go to a testing spreadsheet first, because I did some formulas to kind of visualize this, what would happen under different circumstances. And this particular thing I want to explain, and I know most of you are familiar with this, but for the people out there in the YouTube, if they don't know, I want to just talk a little bit about something. Let's say this is, well, not very straight, but let's say that this is a stock here at 100. And before I go any further, I just want to emphasize my strategy. I'm only doing it in a broad index, generally, S&P. Depending on the account size, would be ES or MES. I'm not doing any stocks, because with this strategy, because it has elements of covered call, it has elements of wheel, it has different elements. You might end up holding the bag for a while, and I have no, well, as long as I can hold it, I don't have a problem holding S&P for a prolonged period of time until it recovers, but I'm not so confident with any particular stock, so I wouldn't be doing that on that. So just keep that in mind. But for the illustrative purposes here, I'm just saying a stock is valued at 100, and if you buy this stock, well, obviously your profit is unlimited to this side, and your losses are limited to zero, basically, right? And this is it. You bought it. Now, a lot of people like to use covered call. So let's say we have here a strike at 105, and let's say we collect $1 in premium for that. Yeah. So if we sell this, well, what will happen? We'll get a little bit higher here for that, and then we'll cap our profits, and then we can basically forget about this. This would not happen. We are capped here, and then our losses to the downside, as it is, plus $1, $100, and then our break even is just moved a little bit here, and everybody's familiar with this part. Everybody's familiar. What some people don't realize, because it's not intuitive when you first hear it, if you have same stock here at 100, you could mimic this thing, just selling a put at 105, and you essentially having the same risk profile. Because think about it, you sold it at 105. What you received obviously 6 for the 5 for the difference here, because you're in the money, and then 1 for the, so 5 plus 1 for the premium for the option. For the extrinsic value. So you have extrinsic plus intrinsic, and you still have $6 here. So you're back here. Your break-even point is again at 99. Everything is the same. Your what do you call it? The profit line looks the same. So there's no difference. The only difference is that here you are holding an option, and you might get assigned if the market moves down on you. But in the meantime, you're using a lot less margin, especially in the futures or on the what is it, the other one. I'm sorry, I'm drawing a blank here for the margin, the portfolio margin. There you go. Okay, so I hope this is pretty clear, and this is just something to keep in mind, because we're gonna utilize this in order to accomplish some of our things. So the idea is that we are doing this in stages, and let's go over the options chain, and let's look at the market, and let's call it again. There is 100 spot price is 100, and then let's say we have the upper. I know the most brokerages have this upside down, but I just like this more intuitive. So 110, and then you would have a 95 and 90, right, like that, things like that. So depending on what the regime is when we start, but let's say that we are in a low VIX environment, and we are starting here, and we want to be low. We want to have low leverage and get a little bit more delta premium as opposed to getting all of it from theta. So instead of selling the usual puts out there somewhere here, and collecting premium and having to sell a lot of naked puts in order to get some premium, we can go somewhere here in this neighborhood and sell much less, let's say one, and then for, let's say your account is 50,000. We're going to run these numbers later on in the spreadsheet, and then the MES, let's say that it's at 5,000, so it would be 25,000 exposure. So that's half 0.5 exposure that I was talking earlier, right? So if you sell this naked put right here, we'll look into the amount of premium, but we are collecting the 5 here and whatever the extrinsic value is, and that extrinsic value stays with us no matter what, regardless of what the market does. We are collecting that. So it's essentially the same as if we had a covered call and bought the stock or bought the MES and sold the covered call. So we're keeping that. If the market goes from here up and passes out, we're keeping also the $5 here. Now these 5 we can only keep as a delta component of this trade because the market moved in our direction, but market doesn't have to move in our direction. So we will keep, regardless, we will keep our $1. But let's say the market goes down a little bit, we will roll this particular strike out in time. We will start with a very short duration, under a week. Let's call it under 7 days. And could be day 2, depending on your schedule or premium any given time, or something that you anticipate in the market. Doesn't matter. You can employ a little bit of your discretion and say, you know what, I'm gonna take 3 days. We want to look at the premium that we're receiving and whatnot. So, but the generic rule would be that we are looking for a very short DTE at this first stage. This is stage number 1, very low premium, and somewhere close to in the money or close to the money. If the market moves slightly down, let's say a 1% or 2%, we're going to roll this out until we can get a little bit more premium. So the roll could be for 7 days, could be maybe 10 days, doesn't matter. It could be just 3 days. It all depends. It's hard to say. It's going to depend on the VIX at that point in time. We're going to generally do that on the last day. We're going to milk out all the premium from the original one. Towards the end of the day, on the expiration day, we'll move it. We'll roll it forward, and we'll either collect a little bit more premium or a lot, depending on, again, on the VIX. So long as this stays doable, we will never move this below this 105 strike. We don't want to book in any loss, directional loss. We're going to keep it until there is no more premium. Let's say the market drops down completely here. Then we're going to get assigned. If there is no more premium, we're going to get assigned here at 105, for example. I'm just giving an example number. And that's fine. This is a low leverage, have 0.5 leverage assigned stock or future or whatnot. And we keep it there. When the market or the premium at a certain level here, and we'll use the spreadsheet to calculate what level we are comfortable with. But it's going to be, let's say, 5% down here. When the premium here, and then here we want to increase the DTE to somewhere, it's hard to say. I'm going to see that live as we go, but somewhere to 2 to 3 weeks, roughly. So the higher the VIX goes, the more we rely on theta, the longer duration we want in order to collect that data, because this is, generally speaking, most of the time we'll be with this one option, and then until market really pulls back. So when that happens, we want to capitalize on that. So as the market pulls down, we want to get more paid more, but at a lower level, and we want to increase duration somewhere around this. So once this particular strike is giving enough premium for us to make sense, which means either market pulled down or the VIX went up, we're going to sell this one. we are now roughly speaking at a full 1x exposure, which is not it's not tragic, even if the market continues to go down. Now, I ask you, if on August you had exposure at 1 and the market dropped down 5%, and you don't plan to close your trade because of the premium increase, would you be worried? I don't think I would be worried. It was just its notional exposure was only 1. And given that we are most likely to experience this huge pullback and increase in VIX, we are most likely to experience that when the VIX is low. That means it's also happening when we're the least exposed. So hopefully that happens when we only half exposed, but it can happen when we are 1x exposed. But let's continue. I will go one further strike down, and this strike is going to be a little bit further down. So let's just call it 90 for now, but we'll go into more precise numbers later on. Now, if this one here starts making sense at around 5 to 6 weeks DTE, we're going to sell this one. Market might still be somewhere around here, but we are selling this one because the VIX is high enough. There is enough premium here to make this work. So we sell it here at this one. Now, remember, if we had 1, 2, 3, if there was no loss in value in the account, we would be at the 1.5 exposure. But there was loss in value in the account. Account is smaller, so we're probably somewhere around 2x. As we go down, and then if we continue to go down, we are going to increase this from this point on. But the plan is, and I would assume that most of the times, because we are now 10% under the market, and this would be correction territory. Well, that happens, but not that often. So I would assume that, most of the times when we do this, we will still not breach this strike and at some point recover. And the plan is we don't have a stop loss or a profit take. We want to milk as much as we want from this because we are not selling regularly. We don't want to count on the next sale the next day. We want to milk out as much as we can. But the idea is to have kind of a stop once the market recovers enough that this original trade here can be closed and rolled or moved higher. That means we're entering a new sequence. This was a sequence 1, 2, 3. We're entering a new sequence. At that point, we want to close these trades, which would most likely be with a very low value, because we want to start fresh and have that ability to do this whole thing again. So let me go back to this point here. If the market was somewhere here, if the market continues to go down, somewhere around here, and can find some more precise parameters, somewhere around here, we can start defending. We're still not closing any of these trades, but we can start employing zebras. And one zebra would cover one of these to the downside. So we can employ one zebra. And then if the market continues down, this one is going to start showing some profit. We can then employ another one a little bit further down. And then if needed, another one to kind of neutralize the position, at least for the time being, and then see how the market goes and go from there. But we would try to neutralize this. By this time, the market would stabilize a little bit. We should be able to put on zebras. And then if the market recovers, we would be losing potentially some money on zebras. But now we would, let me just go back to this point. If we get assigned over time, if we get assigned to all 3 of these, if the market continues to go down, there is not enough premium. So now our average between those 3 would be somewhere around here. We would take you would take assignment here and keep those there, dealing with zebras, dealing maybe on the other side of that. Remember, defined trades. If we had some maybe put debit spreads or some butterflies or something, maybe collect a little bit of premium there. But we would then at some point try to sell some calls for these 3, and we would try to get out. But we would be able to recover before the market does, because our break-even point for these would be further below. But we could, depending on what market is doing at that time, we could let it go a little bit higher. So any questions on this before I go to the spreadsheet? No? Okay. Or what is this? Okay, let's see. Let me go to this spreadsheet, and I created a little sheet with some numbers here to kind of visualize what is likely to happen with a given strikes. So with a given situation. So we're going to use a fictive account at around 50,000, and then right now the market is at what is it? 56 and change. Okay, but let's use 56. So I can change these numbers here. I could put something. The formulas will then change here. But I was using 4% to kind of start from there. I mean, I've tried different things, but this is kind of what I found optimal for right now. And let me just explain what these numbers mean so that you can follow along, right? First one is number of contracts that we sell at any given time. We start with one here, and this is market neutral. Market didn't drop yet. So obviously we're starting at 56. This is the spot. This is a spot, and then later on becomes a strike, and the spot. We sell this one right here. Then let's say 4% under this one, we would sell this one. This is the strike, and we would have two cumulative. Then if the market continues to go down, at this point, at 10%, we would sell the third one. And then we wouldn't sell anymore. We would stop at 3. But the market can continue to go down, and I purposely left all the way down to 25 if we didn't do anything to show that there is a decent risk, even risk of ruin if you overdo it or if you're not careful. But for market to go down 25, that's not going to happen overnight, and we're going to have time to do something here. But let me just show you here the notional exposure. So with one contract, our notional exposure is 28,000. Cumulative obviously goes down goes up as we go sell more. And then intrinsic value loss, and this is if you have one and the market drops 4%, the intrinsic value loss will be on that one particular contract. It'll be 1120. And then if we sell another one, then two of them will go down from 4 to 10%, and that's obviously a larger loss. That would be 4480. And then I added a little bit of extrinsic value, not too much because it's mostly intrinsic value. It's hard to say how much this would be exactly, but I had to put some number just to show that there would be some loss there. But there would be not much, let's say, this first contract, because it was very close to the money and it expired soon. There is no too much value, extrinsic value loss there. But let's say that you can change these numbers as you see fit. But let's say this is it. And then netlick, and then obviously if we go down, this would be netlick minus these two values here. And so intrinsic and extrinsic, and gives us a current netlick given the market pullback. So as you can see, as we go down, one contract, 4%, 10%, at this point, we are down around to 44 or 11, 12%, 12%. So a little bit more than the market. Market is down 10%. We're down to say 12%. Up here, when the market is down 4%, we are less than that. And then this is our netlick divided by notional exposure divided by netlick. So our 0.5 or so, 1, almost 2, and then it's going up from there, as you can see right here. And then buying power usage based on a 4K per contract. So what I witnessed during the last pullback, I think at the height of it, it was around 4,000 per contract that buying power was used. So I would assume that to be pretty kind of worst case scenario for the buying power usage. So obviously with one, we have 4, 8, and then 12, and then it stays 12 because don't forget, we are losing money here on the intrinsic. So the actual buying power is not increasing more than 4 because the market is moving down and it's being taken out of your netlick. So your buying power usage is increasing percentage-wise, but not necessarily the actual amount here. So buying power usage here, based on these numbers, goes something like this, from 8 to 16 to 27 to 34, roughly. These are all obviously numbers that are just theoretical and might change as we go. But you can see here that according to this, we should be pretty good up to this point. We're under 30% roughly. So you can see why I wouldn't be too worried if the market drops, 5% tomorrow and continues down and the VIX increases, because I would still have plenty of buying power and I wouldn't have too much in losses, and I would be able to sell this particular strike here for a decent premium at that point in time. And then it shows 3 here because we're not selling anymore, so just the market is dropping, but we only have 3 of them. And as you can see, the things heat up once you go past the 15% drop. So this is why I'm kind of looking to start defending in this area. Now you could change these numbers based on your netlick and the instrument, but you want to kind of look at what happens. If you go here, if you just go with 2% here and then 8% here, maybe you can see if you like that better or not. But I think 4 and 10 for my size account is probably a good start to start exploring, because we don't want to sell this second one too soon. We want to make sure that there's a little bit of drop in the market and that there is a little bit of increase. There's a premium increase as well, and then we sell the second one. So I think that kind of covers this. Is there any questions with any of this? No? How you like it so far? Anybody has anything? No? All right.
Victor, does it
Yeah.
only covers the case where it's low VIX?
No.
It covers the end. Okay.
No. I don't know if you were here the all time, but we covered here the low VIX and the I'm sorry, this is not let me see. I can't move this. Well, no, we were covering the low VIX. So with the low VIX, we're starting with the initial naked put. In the money, around the money, somewhere in that neighborhood, we're collecting a little bit of theta, a little bit of delta, and then as the VIX increases, we're adding trades below that at a higher premium, at a higher VIX.
Okay, so this assumes you start with a low VIX environment.
No, it doesn't have to start with a low VIX, because then if it was elevated, then the first one would be a little bit below the market. We wouldn't, it would depend on the market. Like, for example, let's take a look today, right? So the market right now is down 0.7, and then the VIX is, close to 17. So it's a mid-range, right? So if I were to take a look at this right here, and let's take 1 day just to see what 1 day would give us. And it's the VIX is not very low, so I don't want to go too much in the money, hoping for the natural drift of the market to come to me. I would probably be somewhere here looking for the high premium that I can collect. So for example, here it's $140, as you can see right here, for one put for 1 day, right? So given that that's pretty high, because anything that goes over 0.1% of my net lick, which would be around $50, it's pretty high. So I do have some leeway here. I could even go and start if I like. This is where the discretion comes in a little bit. For example, let's say Nvidia is doing earnings today. Let's say I'm a little bit, antsy what's going to happen, and I think market might pull back down, but I do want to collect some premium. So I can take a look here. See this is 90. This is still pretty decent for 1 day. Even further down would be decent. Now, this is not like normal course, like I would like to be a little bit closer, but let's say if I'm, if I want to, I can go anywhere down here and collect 90 for one day. I could change that. I could go for 2 days, and do something like this, maybe go a little bit further down or something. But the idea here is not to go with the first strike, with the first sell, not to go too far away from the market. We want to be with the first one, depending on the VIX regime, which is now like neutral. We want to be somewhere around here. We could even feel like, you know what? Hey, let me go and collect a little bit more here. So here I'm collecting 150 in extrinsic value, but the total is 100, let's say 200. So I'm collecting 50 just for the delta if the market comes to me. If for some reason I feel that this would be the right play, but it doesn't really matter. Once I put it here, I'm not gonna move it down. So this is where the discretion comes in. But we could do something like this and go from there. Now, if the market pulls down tomorrow and we end up in the money, we're gonna have to see what happens at the expiration and roll it. But this is kind of what it is. Now, if the market continues down, we would then look into what did we say? We said let's say 4%. So let me. Where is my 5600 minus 4% equals let's say 5375, right? So I would look for a little bit further out of the money and go start here. So 5375. And I would, at this particular time, I would say, nah, this is not enough. The VIX is not there yet. So it would have to, you see, what would happen? Market would drop down, the VIX would go up most likely, and then this becomes sellable. Or I could maybe just take a look at the 22 days and see what's happening here, and then this wouldn't be enough because again we didn't even put the first trade and the market didn't increase and whatnot. And these are some of the put debit spreads that I still have left from the previous couple of weeks. I didn't close them. Now they're bleeding money over the last 2 weeks. Obviously they are negative delta, but I left them on because it was part of the strategy. So if the market continues down, there's a little bit of cushion that I had there from before. But did I explain this with the strike and the VIX?
Yeah, I guess it. Yeah, we
Okay.
need to see it in action.
And Robert, did you have a question?
There we go.
Uh-huh.
Yeah, one of the things I just curious, I don't know if you touched on this because I had to step away for a moment.
Mm-hmm.
I can see how this could work in the SPY. With assignment on MES, it might get tricky. Say you get assigned the September contract.
Mm-hmm.
Would the plan to be to roll to the following contract if you're approaching expiration?
Yeah, I know what you mean. There's a little bit of, I thought about that. There's a little bit of loss, obviously, rolling from contract to contract. For right now, until portfolio margin, I would just accept that as a part of part of the deal. But yeah, it would be preferable to get the portfolio margin and go with the SPY and not worry about that. But for right now, we would do that. Hopefully, we wouldn't have to go too often rolling between the contracts. But yeah, that would be an extra cost involved.
Right. Or maybe we could just manage expectations. Let's say we are, based on the current market, we might want to start looking at the contract, looking at DTEs at the next contract, if we wanted to plan ahead for it.
Yeah, absolutely. But I am trying to capitalize on this first initial one, capitalize on more occurrences. Imagine like if you go to a taxi and then Uber or whatever, a taxi, the first when you sit in it, there's a cost. Let's say it's $5, and then it goes cheaper after time. So as a taxi driver, you want to make as many small rides as you can to capitalize on it. It's kind of a similar concept here, because if you take a look here at one, let's just do at the money just to keep it simple. So here I'm getting 135 for 1 day. So, but I want to collect as many of those as I can. But let's go to 2 days. I'm getting 160 for 2 days for the same strike. So divided by 2, it's already way less. If I go a little bit further down per day, less per day. So if I go here 180 for 6 days, so it gets. I mean, it's preferable to try and sell as many short ones as possible. That's kind of like a goal. Obviously, you can't do that always, but if I could sell this one day and then hopefully be able to sell again 1 day or 2 days, I think it would work better, because we are relying on this initial naked put to collect theta, but also a little bit of delta if the VIX is low and the market is drifting up, and that single naked put is carrying the whole account majority of the time. So we want to make sure that particular put is very profitable, and if we can, obviously. But yeah, I agree with you as well. If you can plan around the expirations just to avoid rolls as much as possible, it would be nice.
Thanks, Victor.
Thank you. Any other comments or any ideas, suggestions, anything?
Hi, Victor.
Hey, Vasim.
Yeah, I have a question, just for me to understand the basics.
Mhm.
So let's assume we sell, 2 DTE put, and then, next day market drops, I don't know, not significantly 2%, but we have a VIX spike like we had in the beginning of August. So we cannot roll, because like bid-ask spreads are not tradable. So
No,
we just,
hold on.
No?
Let me jump in there. I wouldn't say that the bid-ask spreads are going to be not tradable if the market drops down 2%. Like, this is more issue when the market drops down and more significantly, and the VIX goes up significantly, like we had before, or something similar, like a couple of weeks ago, or something similar. If the market drops down 2%, that's just everyday's business. Like right now, it's down 0.7. There is no issues with bid-ask spread. It's pretty tight. So I wouldn't worry about that. Yeah.
Yeah, I understand. I'm not worried about percentage. I'm worried about what happened when VIX jumped to 60, and then we could not close, roll, nothing. Yeah, it was not tradable. Yeah, it's not about percentage. Yeah, you're right. It's about VIX. Yeah. So
Okay.
if it cannot roll,
We take assignment. That's the deal.
Right?
Yeah, that's the whole deal. We don't want to. That my whole point when I was putting this together, I was thinking, I don't want to be forced to close a largely losing trade under the worst of circumstances, which is slippage, gaps, and all of that. So how do I do it? Well, I have to be ready to take assignment. How can I be ready to take assignment? Well, only if I have very minimal number of naked puts. And how can I then make money with a minimal amount of naked puts? Well, I'm going to have to be very close to the money or in the money, depending on the regime. So that's why it's like that. But yeah, if you cannot roll it to a reasonable duration, obviously, if the market drops and you can't do it, let's say going from 2 days to 6 days, well, maybe you can roll it to 15 days, and maybe the slippage is better, or even 30 days, depending on the circumstances. But otherwise, you can just let it get assigned and go from there.
And we're gonna start selling calls on this.
Well, if you can, but if you can't roll, you won't be able to sell calls. Probably you would probably be too far away. But absolutely, yes, the idea is to sell the calls if and when we have underlying assigned to us and the calls are tradable. That would be the idea. Yes.
Yeah. Thank you.
You're welcome. All right. Well, I think we covered mostly the big picture and the finer details, and everything else we'll do as we go along. I think I'm gonna start roughly with the 0 for 10 percentage wise. My account at the moment is down to something like 47, 40, something like that. So this will fit right there, close to half a percent, 0.5x leverage initially, and then go from there. So, all right, guys. If that's obviously, I'll be updating you all in the Discord, and for anybody watching, just make sure you join our Discord. Link is in the description below. And well, now I have to work on this on the spreadsheet, because obviously it's gonna need different formulas, different spreadsheet. We're gonna track everything and see how it goes. All right. Thank you very much,
Thank you.
guys.
Thank
Yeah.
you.
Have a fantastic rest of the day, all. See you later.
Bye bye.
Bye bye.